What if the greatest investor in America wasn't a hedge fund manager, but a woman pushing a shopping cart through Target? What if Wall Street's best-kept secret isn't hidden in a Bloomberg terminal, but in the food court next to the Cinnabon line? It sounds absurd, but Peter Lynch, the man who turned Fidelity's Magellan Fund into a record-breaking machine, built his fortune on a truth so simple, it almost sounds dumb. Invest in what you already know. While other analysts were buried in spreadsheets, he was watching what people bought at the mall. When pantyhose showed up in grocery stores, he saw legs explode. When teenagers flocked to Dunkin Donuts, he leaned in. He didn't chase stock tips. He chased consumer behavior, and it worked. From 1977 to 1990, Lynch averaged over 29% returns annually, turning $18 million into $14 billion. Let that sink in. And yet, decades later in 2025, we're still glued to noisy charts, screaming headlines, and crypto speculation. We've forgotten how to observe the world that's right in front of us. What if your daily life, your receipts, your closet, your lunch order, held the next Tenbagger? This video isn't just a summary of Peter Lynch's book. It's a transformation, a reawakening. You're about to become a mall detective, someone who sees with investing eyes, who walks through the world as if every product, every brand, every line of customers is a clue. This isn't finance, this is field work. And by the end of this video, you won't shop the same way again. Because the real advantage isn't in predicting the market, it's in noticing what the market hasn't caught up to yet. You don't need Wall Street's permission to become wealthy. You just need to open your eyes and look around. Chapter 1. The Cart That Sees the Future. There's something oddly magical about grocery carts. Not because they carry bread or milk, but because, as Peter Lynch proved, they sometimes carry tomorrow's stock market winners. The ordinary act of shopping, of pushing a cart down the aisle, can become an extraordinary tool for building wealth, if you know how to look. Lynch believed that your personal life is your edge, not your MBA, not your portfolio manager, just your life. In the early 1980s, he noticed a peculiar pattern. Women were buying legs pantyhose, not from department stores, but straight from grocery shelves. It was a quiet revolution. No press releases, no stock hype, just consumers voting with their wallets. He watched, he listened, he invested, and legs skyrocketed. This is the essence of the mall detective. You're not waiting for CNBC to tell you what's hot. You're watching your sister's favorite shampoo suddenly vanish from the shelves. You're noticing the lunch spot near your office that went from half empty to always packed. These aren't coincidences. These are clues. But here's the twist. Most people ignore them. They believe investing is reserved for the brilliant, the connected, the suit-wearing elite. That's the lie. The truth, the closer you are to the ground, the clearer the signal. When Lynch saw that every teenage girl had a pair of Calvin Klein jeans, he didn't brush it off. He leaned in. And when he saw lines out the door at Taco Bell, before analysts ever noticed, he started crunching numbers. The story of Dunkin Donuts is another iconic case. Lynch saw the lines. He tasted the product. He looked into the company's growth numbers. Consistent, scalable, under the radar. So, while everyone else obsessed over IBM and oil stocks, he bought donuts and profited massively. Think about your own habits. What's the last product you used that wasn't advertised but everyone around you seems to love? A brand blowing up on TikTok but still underpriced on the stock exchange? You might be holding a clue worth thousands. This isn't a fantasy. It's pattern recognition. It's being curious in the real world. If you're the first to notice that all the teens are obsessed with a certain app, or your gym just replaced all their drinks with a new brand, that's your moment. Investigate. Because Lynch's edge wasn't in spreadsheets. It was in supermarkets. So next time you shop, don't just spend. Watch, observe. Note which shelves are empty, which products are multiplying. And ask, is this just a trend or the next Tenbagger? But this is just the first lens, because spotting a product is only the start. In the next chapter, we uncover why the ugliest companies, the ones no one talks about, might just be the hidden kings of your portfolio. Chapter 2. Beauty is a Trap. Imagine this. You walk past a crumbling building with peeling paint, a name no one's heard of, and a logo that looks like it hasn't been updated since 1973. You don't give it a second glance. Why would you? It's ugly, it's boring, it's forgettable. But Peter Lynch would have stopped. He would have squinted through the windows, asked what they do, and started following the money. Because in the stock market, beauty is often a disguise. And ugliness, that's where the treasure hides. Lynch called these companies unloved. They don't get media attention. Their CEOs aren't tweeting. They're not sexy. But they're profitable, consistent, and quietly growing, while the rest of the world is distracted by shiny tech toys. He once bought into a company that made barrel cleaning equipment, another that sold grave markers, another that managed waste. That's right, garbage. Waste management wasn't exciting, but it had something better than excitement: predictable cash flow. And it outperformed many Wall Street darlings. In a world obsessed with flash, where Tesla and Meta dominate headlines, these forgotten giants keep stacking returns. You'll never hear someone brag about owning a stock that sells floor wax or janitorial supplies. But Lynch would smile at that silence. Because silence means no hype, no overvaluation, no bandwagon, just pure potential waiting to be discovered by someone brave enough to look past appearances. Let's bring it to today. In 2025, what's the equivalent of boring? Maybe it's a regional pest control company. Maybe it's a firm that rents out portable toilets to festivals and construction sites. Not glamorous, but ask yourself, is demand steady? Is competition low? Is it expanding territory? That's what matters. Lynch didn't care if the company was sexy. He cared if it made money and kept making money. Here's the trap. As modern investors, we're drawn to what dazzles: AI, crypto, EVs. And sometimes those sectors do offer real promise. But when everyone's looking right, opportunity slips in from the left. Remember, Amazon in its early days looked like a risky online bookstore. Netflix mailed DVDs. Nvidia was once just a gaming card company. Before they were giants, they were whispers. The ugly ones aren't always easy to love, but that's the point. They're under the radar. They're cheap for a reason, and that reason is often superficial. So ask yourself, what companies have you overlooked because they just didn't seem exciting enough? What's quietly cleaning up, literally or figuratively, while everyone else is chasing moonshots? Because the next big opportunity might not be hiding behind a glossy pitch deck. It might be right under your nose, quietly compounding while no one's paying attention. But what if the ugly company isn't just consistent? What if it's growing faster than anyone realizes? In the next chapter, we explore how Lynch uncovered Tenbaggers, not through hype, but through real-world acceleration. Chapter 3. Catching a Tenbagger before the crowd. A Tenbagger. Just saying the word feels electric. It means a stock that grows 10 times your investment. Put in $1,000, walk out with $10,000. It's not fantasy. It's happened, again and again. But here's the thing Lynch figured out. Tenbaggers don't wear neon signs. They don't beg for your attention. They whisper. They start small, feel ordinary, and only reveal their power to those who watch closely. In the early days, Taco Bell was just a fast food chain trying to carve space in a world ruled by McDonald's and Burger King. But Lynch saw something no one else did: foot traffic. He noticed the lines getting longer. He saw repeat customers. Then he looked at the numbers: growing revenue, scalable model, room for expansion, and minimal competition in its niche. While others shrugged, he bought, and watched it become a Tenbagger. So, what does a Tenbagger look like in 2025? It might be a hydration brand teens are addicted to, a regional grocery app quietly spreading across suburbs, a small robotics company powering warehouses behind the scenes. The trick? Spot the acceleration before it becomes obvious. You want a few clues? Lynch gave them. A company with a small market cap, but strong sales growth, a loyal customer base, but limited media buzz, a product that solves a daily problem, but isn't flashy enough to go viral. Combine those, and you might be staring at something explosive. Let's turn this into a story. Imagine you're at a college campus. Everyone's drinking this weird new energy water. It's not even in stores yet, just sold online. But students are bulk buying. Cafeterias are signing contracts. You try it. It tastes good. You research the company. New CEO with a background in scaling food brands. Sales have tripled in 12 months, and manufacturing costs are dropping. No major funds hold it yet. That's when the detective in you says, this isn't noise, this is growth. But this isn't about jumping at every trend. It's about recognizing momentum backed by real business fundamentals. Tenbaggers aren't lottery tickets. They're trains you board early, while the station is still quiet. Lynch didn't just chase growth. He stalked it. He watched it build. He confirmed it with earnings reports, store visits, employee interviews. He pieced together a mosaic. That's what separates dreamers from detectives. Have you ever used a product and thought, why isn't everyone using this? That's your moment. The world hasn't caught up yet, but you have. The question is, will you act? Because in the next chapter, we'll unlock a tool Lynch used to measure not just potential, but the price you're paying for it. Get ready to see value through a magnifying glass. Chapter 4. The Peg Ratio Spyglass. Sometimes a stock looks like a rocket, revenue soaring, headlines glowing, analysts cheering. But there's one question every smart investor should ask before boarding that rocket. Am I overpaying for this ride? That's where the PEG ratio becomes your spyglass. Peter Lynch loved the PE ratio, but he added one simple twist that changed the game. Divide it by the company's growth rate. That's PEG. And that little slash mark, it's the line between buying brilliance and buying a bubble. Let's say a stock has a PE of 30. Sounds expensive, right? But what if it's growing earnings at 30% a year? Suddenly the PEG is 1. That's fair. Now, imagine a flashy tech stock with a PE of 50 but growing at just 10%. PEG star 5. That's not a rocket. That's a ripoff. Lynch used the PEG ratio as a gut check. If PEG 1, the stock might be undervalued for its growth. Between 1 and 2, proceed with caution. Over 2, likely overpriced hype. Let's bring this into 2025. You hear about a company called Pulseware, a new entrant in the wearable tech space. Your gym buddies are all wearing it. It monitors hydration, posture, even vitamin absorption. You're intrigued. The stock's PE is 40. Expensive? Maybe. But when you dig in, earnings have doubled year over year. Growth rate, 50%. PH, or 0.8. Now you're seeing through the hype. It's not just hot, it's possibly a deal. The PEG ratio filters your excitement, because excitement without measurement is a gambler's high, and gamblers lose. Lynch didn't just guess, he investigated. He walked through malls, but then he walked through balance sheets. He cross-examined story and substance. Numbers aren't cold, they're clues. The PEG ratio became his truth serum, slicing through hype to reveal what a company was truly worth relative to its potential. This matters now more than ever. In 2025, AI startups, battery tech, gene editing firms, they're everywhere. But just because something is the future doesn't mean it's a good buy today. That's why the PEG ratio isn't just a metric. It's a discipline. It's the voice that whispers, cool story, but are the numbers backing it up? So, the next time someone tells you, this stock is going to the moon, grab your spyglass, plug in the PEG, and ask, am I buying growth or just fireworks? But sometimes, even when the numbers look good, something shifts. The story turns sour, the rocket wobbles. That's when every great detective needs to know when to step back and walk away. In the next chapter, we uncover the subtle signals that say, it's time to sell. Chapter 5, The Expired Candy Test. Imagine walking into a store and spotting your favorite candy on the shelf. Same colorful wrapper, same logo. You grab it without thinking. But when you bite into it, something's off. It tastes stale. The sweetness is gone. That's what it feels like to hold on to a stock whose story has expired. The branding may look the same. The company might still be on the shelves of Wall Street. But under the surface, the flavor is gone. Peter Lynch didn't just know when to buy. He knew when to let go. And he did it without emotion, because a great company can become a bad investment if its story changes. Maybe growth stalls, maybe competition swarms, maybe management loses focus. Lynch called this when the story breaks. And when it does, it doesn't matter how much you love the product. You sell. One of his famous examples was Fannie Mae. It had become a darling, steady growth, market leadership, consistent profits. But when regulatory pressure and interest rate changes started reshaping its foundation, the story cracked. Lynch didn't cling. He moved on. Think of a company like Peloton. In the early 2020s, it soared. Pandemic demand, subscription models, cult-like community. But by 2023, demand shrank. Inventory piled up. The narrative of revolutionizing fitness had aged into struggling to stay relevant. If you were watching with open eyes, the signs were there. So how do you know when a stock's candy has gone stale? Start with this. Is the original reason you bought still true? If you bought a company because it was expanding stores every year, and now they're closing them, something's changed. If you loved their CEO's bold vision, and he's been replaced by a cost cutter, reassess. Lynch said, the The stock doesn't know you own it. That means you owe it nothing. No loyalty, no attachment. Selling isn't failure, it's clarity. The best detectives don't get emotional about suspects. They follow the facts, and the facts will tell you when the game is over. But here's the deeper truth Lynch uncovered. Sometimes the story doesn't break all at once. It crumbles quietly. Sales slow, margins compress, management avoids eye contact on earnings calls. The candy looks the same, until one day it doesn't. Have you ever held on to a stock, or even a dream, long after its flavor was gone? It's human. We confuse time invested with value, but smart investors know. You can love the story, but you must marry the truth. In the next chapter, we shift from stories to identities, because every stock wears a mask. But if you learn to recognize its true category, you'll know exactly how it behaves and when to act. Chapter 6: 6 Masks Stocks Wear. Not all stocks are created equal. Some whisper growth, others scream stability. Some are roller coasters you hold with both hands, and others are slow, steady escalators you barely notice. But most investors treat them the same, buying and hoping, holding and praying. Peter Lynch knew better. He didn't just look at a company, he classified it. Because once you know what type of stock you're dealing with, you can predict how it moves, when it shines, and when it turns. He gave us 6 masks, 6 archetypes, 6 stock personalities hiding in plain sight. Slow growers. These are your dividend darlings, utilities, conglomerates. They grow slowly, but pay reliably. Think of them as the old uncles at the family dinner. Predictable, comforting, and occasionally generous. Stalwarts. Big companies that grow moderately, Coca-Cola, Johnson & Johnson. They're not exploding, but they're solid. Lynch liked them for safety with a little upside, like a well-insured house with rising value. Fast growers, the gems. These are your Taco Bells, your Dunkins, your local businesses doubling sales year over year. High risk, high reward. If you find them early, they can be life-changing. Cyclicals, car companies, airlines, steel. They rise and fall with the economy. Timing is everything here. Lynch treated them like tides. Learn when they come in, and don't get caught swimming when they go out. Turnarounds. Broken businesses fixing themselves. High drama, high risk. But if the story flips, they go from disaster to delight. Asset plays. These are the buried treasure stocks. Companies that look average on paper, but secretly hold valuable assets, real estate, patents, or cash piles the market hasn't priced in yet. Lynch didn't guess. He labeled. Why? Because once you mislabel, you mistreat. If you expect a cyclical to behave like a stalwart, you'll panic during a dip. If you treat a fast grower like a slow grower, you'll sell too soon. It's not about prediction. It's about pattern recognition. Let's say in 2025, you're looking at a mid-sized cloud security company. Its revenue is doubling. Customers are sticky. Competition is weak. Don't call it a safe stock. It's a fast grower. Treat it like one. Watch the expansion, monitor the margins, and expect volatility. Hold with courage, not complacency. Or imagine an airline stock with a too-good-to-be-true price. Dig deeper. Is it a cyclical at the bottom, or a turnaround, or is it just failing? This classification system is like switching from black and white vision to full color. Suddenly, the market makes sense. You stop reacting emotionally and start seeing clearly. So next time you analyze a stock, ask, what mask is it wearing? And better yet, what's underneath that mask? But knowing the mask isn't enough. Sometimes your edge isn't from the charts or the earnings reports. It's from a place even simpler. In the next chapter, we uncover why children might be the best stock analysts in your household. Chapter 7: Investing with Childlike Eyes. In a world obsessed with complexity, Peter Lynch found his edge in simplicity. While other investors drowned in models and metrics, he asked his daughters what clothes they liked. He watched what his wife brought home from the mall. He listened to what teenagers were buzzing about in line at the food court. Not because he was lazy, but because he was smart. He knew that children see what adults overlook. Why? Because kids aren't blinded by valuation models or earnings calls. They notice what's cool, what's spreading, and what's sticking. They're on the front lines of trend formation. Lynch called this the edge of the ordinary. He bought into Hanes because his wife loved their products. He considered the limited because his daughters wouldn't shut up about it. He took their observations seriously, not as financial advice, but as an early alert system. Let's make it modern. In 2025, your teenage nephew refuses to drink soda, but is obsessed with a Korean probiotic sparkling drink. You see him post it weekly on TikTok. His friends copy him. The shelves at Whole Foods are running low. You try it. It's great. You research the parent company. It's a small-cap import brand with exploding U.S. sales and a distribution deal just inked. That's not a coincidence. That's a clue. Because while adults are debating interest rates, kids are creating consumer futures. They move markets, especially in fashion, snacks, entertainment, and tech. Roblox didn't explode because adults loved it. It exploded because children pulled their parents into it. Crocs didn't come back because of Wall Street. They came back because Gen Z decided rubber shoes were cool again. Story time. A father notices his kids are addicted to a new educational tablet. The brand isn't mainstream yet, but their school just placed a big order. He investigates the company. Turns out, they've doubled school contracts year over year and are quietly entering new states. He buys. 2 years later, the stock has quadrupled. That's not luck. That's observation. And it forces a question. When was the last time you asked the youngest person around you what brand they're obsessed with? If your answer is never, you're missing out. Not every trend becomes a Tenbagger, but every Tenbagger once started as a whisper. And those whispers often start in playgrounds, gaming chats, and dorm rooms. So, the next time a kid passionately pitches a brand you've never heard of, don't roll your eyes. Ask questions. Watch behaviors. Let curiosity lead you. Because the edge is no longer just about knowledge. It's about noticing before the market notices. But observation alone isn't enough. In the next chapter, we explore how the voices you trust might actually be your biggest threat, and why the loudest investor in the room is usually the one losing money. Chapter 8. Escape the echo chamber. There's a strange thing that happens when you enter the world of investing. Suddenly, everyone becomes an expert. Your uncle at Thanksgiving has a hot tip. A YouTuber with cinematic B-roll promises the next 100x crypto. CNBC is buzzing with predictions, and Reddit's telling you to hold no matter what. It's deafening, it's addicting, and it's deadly. Peter Lynch saw through it all. He didn't care what the crowd was chanting. He cared about what he saw, what he researched, and what the company was actually doing. Because in investing, the moment you outsource your conviction to someone else's voice, you become a passenger, and the markets don't reward passengers. He called it the noise. And in today's digital world, that noise has mutated into a full-blown echo chamber. The algorithm shows you what you already believe. If you love Tesla, you'll be flooded with videos confirming it's going to $10,000. If you fear a crash, you'll find 100 bearish prophets fueling your doom. But Lynch operated outside the chorus. He was a field detective, not a pundit parrot. He went to malls, he walked factory floors. He didn't ask what they thought. He asked what he could see. In the 1980s, he visited companies before buying. He talked to managers. He looked at store traffic. Today, you have even more tools. You can check App Store reviews, search volume. You can walk into stores, observe demand, or even ask employees if the company's cutting shifts or adding staff. But none of that matters if your mind is hijacked by someone else's conviction. Imagine this. A young investor in 2025 hears a charismatic influencer raving about a virtual pet token. It's the future, they say. It's Web3 meets AI meets gaming. But the investor doesn't research, doesn't check the team, the roadmap, or the usage stats. They just ape in. A month later, rug pulled, zeroed out. And they didn't just lose money, they lost time, trust, and belief. Lynch didn't avoid mistakes, but when he made them, they were his. And that gave him clarity. Ownership of the decision. No blame, just learning. Ask yourself, whose voice is guiding your portfolio? Is it your voice or an echo bouncing around Twitter and YouTube? Because until you break free from the echo chamber, you're not investing, you're following. And following is dangerous when cliffs are everywhere. The antidote? Build your thesis. Write it down. Watch the company, track the progress. And let your experience, not someone else's excitement, be the foundation. Because in the next chapter, we'll explore the ultimate test of clarity. If you can't explain your investment in one sentence to a stranger in a bathroom, you don't understand it well enough to own it. Chapter 9, the bathroom pitch test. Picture this. You're at a dinner party. Halfway through, you duck into the restroom, and someone strikes up conversation as you both wash your hands. So, they say, what's the one stock I should buy right now? You've got 10 seconds. No slides, no charts, no jargon, just your words. What do you say? Peter Lynch believed that if you couldn't explain why you owned a stock in one sentence, one clear, grounded sentence, you had no business owning it. He called it the bathroom test, because investing should never be a mystical puzzle. It should be simple enough that if you ran into someone on the street or in the restroom, you could explain it before the sink shut off. Here's what doesn't pass the test. Well, it's got a 38.5 forward PE with strong options activity and a DeFi NFT bridge powered by quantum LLM infrastructure. That's not conviction, that's camouflage. Here's what does. I own this stock because it makes the best affordable athletic wear for teenagers, and every high school I walk into is filled with their logo. Or, I'm invested because this company owns warehouses for AI chip factories, and demand is exploding. One sentence. Real world, real clarity. Lynch didn't buy companies he didn't understand. He avoided biotech startups he couldn't explain. He loved boring companies with simple business models. Dunkin Donuts. People eat donuts every morning. Taco Bell. Cheap fast food with rapid expansion. These weren't complex pitches. They were obvious once you opened your eyes. Let's ground it in 2025. You hear about a company called Clean Loop. They recycle plastic into modular bricks used for sustainable housing. You walk by a construction site. Those bricks are everywhere. You Google it. Backlog orders are up 200%. That's the moment you condense it. They turn trash into homes, and cities are lining up to buy. Boom, that's a bathroom pitch. This test does something powerful. It forces clarity. It makes you strip away the fluff and get to the essence. Why this company? Why now? What's the real driver of value? If you can't explain it, don't buy it. Or at least, don't buy it yet. Dig deeper. Watch. Learn. Wait until the story sharpens in your mind. Because your words shape your conviction. And conviction is what keeps you calm when the market turns red. So here's your challenge. Go through your portfolio. Write one sentence for each holding. If you stumble, rethink. If you ramble, recheck. And if you can't say it out loud without confusing someone, you might be confusing yourself. But what if the story sounds simple, but the company isn't telling the full truth? In the next chapter, we dive into how silence, what management isn't saying, can be louder than words. Chapter 10, What the CEO Isn't Saying. In the world of corporate earnings calls and glossy investor decks, the most revealing signal often isn't what's said, it's what's left out. Peter Lynch had an uncanny ability to read between the lines. He didn't just listen to management's words, he studied their behavior, their actions, their timing. Because he knew something most investors still forget. CEOs may talk with confidence, but they vote with their feet. Let's be clear, every CEO sounds bullish. It's their job. They talk about synergies, growth potential, exciting quarters ahead. But while their mouth paints a masterpiece, watch their hands. Are they buying shares or quietly dumping them? Are they increasing R&D or slashing budgets while promising innovation? The truth is often in the footnotes, not the headlines. Lynch was obsessed with insider buying. When executives purchased their own stock with their own money, that was a signal. Why? Because they already have skin in the game. If they're putting more on the table, it's because they believe something good is coming. On the flip side, when multiple insiders start selling without explanation, especially before earnings or after a hyped-up event, alarm bells ring. Fast forward to 2025. Imagine a mid-sized EV battery company, shiny branding, influencer partnerships, constant media coverage. But dig deeper. The CFO quietly resigns. The CTO sells 80% of his stake over 2 months. R&D spending drops. Yet, the press release reads, "Full steam ahead." That's not confidence. That's camouflage. And if you're only reading headlines, you'll miss it. Lynch once said, "The company that's always talking about its future is probably hiding something about its present." He trusted patterns, not promises. Watch how a company treats its workers. Are stores closing silently while headquarters posts record profits? Are executive bonuses rising even when customer satisfaction plummets? That dissonance is often a telltale sign of rot beneath the surface. Real story. In the early 80s, a firm announced a bold pivot into a hot new sector. But Lynch noticed something odd. None of the top execs were buying shares. In fact, they were cashing out. Investors flooded in. The stock surged, then collapsed within the year. The hype was a distraction. The behavior told the truth. So, what does this mean for you? Never just listen to what the CEO says. Watch what they do. Read the 10K. Track insider activity. Follow layoffs, hiring freezes, and CapEx trends. These are breadcrumbs leading to the real narrative. Ask yourself, if the person selling you the story won't buy their own stock, why should you? But sometimes, the best investments are the ones no one is even talking about. Not because they're hiding something, but because they're just plain boring. And in the next chapter, we'll explore how the most unremarkable names often produce the most remarkable returns. Chapter 11. The boring name, Jackpot. If you were walking through the stock market like it was a job fair, you'd probably skip the booth labeled Automatic Data Processing. The name sounds like a printer manual. No drama, no flash, no mystery. But Peter Lynch would have made a beeline for it. Because behind that boring name was a beautiful business, quietly growing, wildly profitable, and mostly ignored. And that's exactly what made it valuable. Lynch loved boring names. Why? Because boring names kept the hype away. No Reddit mobs, no CNBC specials, no inflated expectations. Just solid companies, quietly doing what they do best, year after year. And when you dig into the numbers, the real surprise isn't that they grow, it's how consistently they grow. Take WD-40. It sounds like something your dad uses on a squeaky hinge, but its product is so universally useful, so dominant, and so hard to replicate that it's a cash machine in disguise. Nobody's bragging about owning WD-40 stock, and that's precisely why it keeps winning. Lynch once joked that the more boring the name, the better the returns. Tom's Pickle Company might outperform Neurofusion Quantum AI. Why? Because the latter attracts speculators, while the former attracts no one, except a few smart detectives. Now, think about your own instincts. When scanning stock names, do you skip over ones that sound like they belong in a filing cabinet? You're not alone. That's the trap. Modern investors want to feel cool about their portfolio. They want to talk at dinner parties about their biotech moonshot, their blockchain disruptor, their next-gen immersive metaverse token. But remember, investing isn't performance art. It's about results, quiet results. Let's go 2025. A company named Regional Parcel Logistics. Not sexy, but they own the last-mile delivery market in 5 underserved states. No competitors. Steady contracts. You check the books. Revenue up 18% annually. Low debt. Solid margins. The name screams sleep. The stock screams opportunity. This is the paradox. The market often undervalues what it can't hype. And if you, as a mall detective, can train your mind to look past the packaging and into the product, you'll find jackpots where others yawn. Ask yourself, what stocks am I ignoring simply because they sound dull? What if the next great investment isn't a rocket ship, but a mop, a uniform, or a software that helps manage payroll? Because boring names don't stay boring when the returns pile up. They just make fewer headlines and bigger bank accounts. But what happens when a boring company tries to become something it's not? When a great business starts collecting shiny objects and loses its focus? In the next chapter, we reveal the hidden illness that kills more great companies than competition ever could. Chapter 12. The Diworseification Disease. It begins innocently enough. A great company dominates its niche, stacks profits, builds trust. Then the boardroom gets itchy. Let's expand, someone says. Let's buy something big. They start acquiring businesses they don't understand, entering markets they have no edge in, chasing trends instead of doubling down on what works. Peter Lynch had a word for this disease: Diworseification. The art of making a strong business worse by diversifying into everything and mastering nothing. Lynch saw this again and again. Companies with a clear identity, laser-focused, efficient, admired, suddenly bloated themselves trying to be everything to everyone. He wasn't against growth. He was against mindless expansion. And the numbers proved him right. Many of these conglomerates underperformed for years because they diluted what made them great in the first place. One of his classic examples: a successful soft drink company buys a chain of movie theaters. The logic? Both are entertainment. The result? Chaos, mismanagement, culture clashes. and the core business suffers while executives pretend they're visionaries. Let's bring this to now. In 2025, you hear about a company called Farm Fresh Organics. They've grown fast selling premium produce subscriptions, beloved by customers, efficient distribution. But suddenly, they acquire a biotech lab. Then they announce an NFT loyalty platform. Then they partner with a drone company. The stock price spikes on hype. But you notice something. Margins shrink. Churn increases. The story, once clean and powerful, becomes murky. That's Diworseification in action. Peter Lynch knew that the best companies are usually the best because they focus. They do one thing better than anyone. They scale it with discipline. And when they expand, they do it with logic, not ego. He warned investors, when a company gets too rich, too bored, or too obsessed with being next gen, they often lose their soul. Instead of reinvesting in their best people or improving product quality, they spend billions acquiring unrelated firms, usually at the top of the cycle. Want to spot it early? Look for language like strategic realignment, new synergies, or visionary horizontal integration. These are boardroom smokescreens for, we're guessing, and it's expensive. Ask yourself, is this company sticking to its core strength or chasing distractions? If a bakery starts building smartphones, run. Because, as Lynch said, more companies die of indigestion than starvation. And sometimes the most profitable move a business can make is to stay in its lane, refine its craft, and go deeper, not wider. But what if the company already left its lane, crashed, and is now trying to climb back up? In the next chapter, we explore the high-drama world of turnarounds and how to spot the few that rise from the ashes. Chapter 13, The Turnaround Temptation. There's a peculiar thrill in watching a company on life support suddenly show signs of a heartbeat. Investors love a comeback story. A stock once beaten down, left for dead, now whispering promises of revival. It's seductive, it's dramatic, and Peter Lynch didn't shy away from it. But he approached it with surgical precision because while some turnarounds fly, most flatline twice. A turnaround, at its core, is a bet on transformation. New leadership, new strategy, a market shift. But here's Lynch's golden rule. The story must already be improving before the stock price reacts. Not will improve, not should improve. Already improving. He loved companies with strong brands that had stumbled, not collapsed. A broken balance sheet, maybe fixable. A destroyed reputation, not so much. The key was to look for evidence, not just hope. New sales momentum, a profitable quarter after losses, shrinking debt, renewed demand. That's when Lynch would perk up. Take Chrysler in the early 80s. Everyone had given up, but Lynch saw Lee Iacocca take the wheel, government loans kick in, and a lineup of new cars gaining traction. The real-world shift was already happening. He invested and rode the comeback. Now zoom into 2025. Imagine a company called Stream Surge, a once popular video platform that lost ground to TikTok clones. Their stock crashed, but then a new CEO with a history of successful turnarounds steps in. They cut overhead, rebrand with an education-first model, land deals with universities. App Store reviews go from 2.1 to 4.4. Content creators return, ads pick up. Revenue turns green for the first time in 8 quarters. That's when the smart money moves, not when it's still in ICU, but when it's learning to breathe again. But beware, most investors jump in too early. They fall in love with the idea of redemption. They ignore debt, ignore product decay, ignore customer loss. They mistake desperation for disruption. Lynch avoided that trap. He knew that unless the company proved its new path with results, it was just storytelling in a tuxedo. So ask yourself, is this turnaround already turning? If you see real numbers shifting, employee morale rising, customer engagement returning, lean in. If not, step back. And remember, not all companies deserve a comeback. Some fail for good reasons. Poor leadership, obsolete products, cultural rot. A rebound isn't owed, it's earned. But for those that do rise, the upside can be stunning because the market is slow to believe again. That gap between disbelief and transformation, that's where your profit lives. Still, there's one more layer of protection you need, because even great companies, whether rebounding or booming, can become lethal investments if you pay the wrong price. In the next chapter, we dive into the silent killer of portfolios, valuation traps disguised as opportunity. Chapter 14, the value trap disguised as a deal. It's the investor's mirage. A stock looks cheap, the price is down, the PE is low, the chart screams bargain. And yet, like a beautifully wrapped box full of sand, it delivers nothing but disappointment. Peter Lynch called this the value trap, a stock that looks undervalued but is actually priced just right, for a reason. He warned investors not to be seduced by numbers alone. A low PE doesn't always mean undervalued. Sometimes it means unloved, and rightfully so. Lynch looked deeper. He asked, why is it cheap? Is the business broken? Are the earnings peaking? Is this industry in structural decline? Take the once glorious newspaper companies. In the early 2000s, they had low valuations and steady past profits. But the internet was devouring their future. People bought them thinking they were getting historic brands at a discount. What they really bought was a slow-motion collapse. That's the value trap. Let's fast forward to 2025. A company called Photolab Inc. trades at 6x earnings. It once dominated instant photo booths at tourist sites. Now it's cheap. But wait, tourism has gone digital. People use AI photo filters. Locations are removing booths to make space. Revenue is down 11 straight quarters. The stock's cheap not because the market's blind, but because the product is dying. That's not a deal. That's a trap with a discount tag. Lynch avoided these by checking the pulse. He'd ask, is the business getting better or worse? If earnings were declining, he looked at why. Was it a blip or a trend? Was there new leadership, new products, new energy, or just more excuses? Even great companies can become traps if bought at the wrong time. Remember, if you find a diamond in a dumpster, it doesn't matter how cheap it is if it's chipped beyond repair. Lynch reminded us that a company's price only matters if the future holds promise. Otherwise, you're paying for a ghost. One of his favorite techniques? Compare the PE to the growth rate, the PEG ratio again. If the company's growing earnings at 5% and trades at 20x earnings, be careful. If it's shrinking and still trades above 10x, danger. Story time. An investor in 2023 sees a retail brand he loved as a child. Shoes, logos, nostalgia. The stock is down 70%. He buys big. But he doesn't realize that Gen Z sees it as cringe. Inventory builds. Store closings rise. No one under 30 wears the brand. By 2025, the stock is delisted. What looked like a comeback was really a curtain call. So here's the lens. Don't ask if it's cheap. Ask if it's cheap for a reason. If the company is growing, adapting, surprising customers, maybe it's a bargain. But if it's standing still while the world moves on, that's not value, that's rust. Because in the next chapter, we explore what happens when the company is great. The growth is real, but you, yes, you, become your own worst enemy. Let's talk about the psychological traps that sabotage even the smartest investor. Chapter 15, the mirror trap, when you are the problem. You've researched the company, the numbers check out. The product is amazing, the stock starts to rise, and then it dips. You panic, you sell. Days later, it rebounds. You kick yourself. Then you jump back in, at a higher price. It dips again. You sell again. Now you're exhausted, bitter, and poorer. But here's the truth Peter Lynch would whisper if he were beside you. The stock didn't fail you. You failed yourself. This is the most brutal revelation in investing. Sometimes the enemy isn't the market, the media, or the company. It's your own mind, your fear, your impatience, your addiction to movement. Lynch knew this. That's why he preached one word over and over: discipline. Not brilliance, not timing. Discipline. He once said, the key to making money in stocks is not to get scared out of them. Because most investors lose not from bad picks, but from bailing on good ones too soon. They sell at the first sign of volatility. They confuse normal fluctuations with danger. They seek comfort when the game requires conviction. Let's bring it to 2025. You discover a cloud storage company, Skylock, with strong recurring revenue, growing clients, and a CEO with a golden track record. You buy in. Stock jumps 20% in 3 months. Then, boom. AI rumors cause a market-wide dip. Your stock drops 15% in 2 days. Panic sets in. You exit. A month later, the company reports record earnings. Stock soars 40%. You're out of the story, not because the company failed, but because your emotions took the wheel. Lynch compared this behavior to planting seeds and digging them up every week to check the roots. Stocks need time. Growth takes patience. The noise will tempt you. Headlines will scream. Social media will mock your calm. But your greatest edge is this: your ability to stay when others flee. So how do you protect yourself? Write a thesis. Know why you bought. Keep it visible. If that thesis hasn't broken, don't flinch. Turn off the noise. Limit your exposure to daily stock news. Focus on the company, not the crowd. Expect drawdowns. Even great stocks drop 20–30% on the way up. That's the toll you pay for riding long-term growth. Track your reactions. Journal your trades. You'll start to notice patterns. Fear-driven exits, FOMO entries. Lynch made fortunes not because he was superhuman, but because he trained his emotions like a soldier. He bought when others hesitated. He held when others fled. And he reviewed his logic when others reacted to headlines. Ask yourself, have I sabotaged my own success by reacting too quickly? Because the most powerful stock you own might already be in your portfolio, but only if you get out of your own way. But what if you're new, overwhelmed, and don't know where to start? In the next chapter, we reveal how Lynch made the complex simple by boiling everything down to one golden question that can filter out 90% of bad decisions. Chapter 16, the golden question that filters everything. Peter Lynch didn't have a million tools on his desk. He didn't rely on exotic algorithms or insider whisper networks. What he had was one golden question, one that sliced through hype, emotion, and confusion like a scalpel. Before he bought any stock, he'd ask, what's the story? Not the chart, not the news headline, not what Reddit says. The story. Because every winning investment has a clear, compelling narrative that answers, what does this company do? Why will it grow? And why now? It sounds simple, because it is. But that's the magic. When you force yourself to write out the story in a paragraph, or even a sentence, clarity appears. Weak ideas collapse. Shiny distractions fade. Lynch didn't invest in tickers. He invested in stories with legs. Let's say you're looking at a company called CareNet in 2025. It offers subscription-based in-home healthcare for aging populations. The story? As baby boomers age and nursing homes overflow, families want personalized home care. CareNet offers a scalable, trusted solution, and they're expanding into 12 new states this year. That's a story with direction, emotion, and logic. But what if the story sounds like this? It's a blockchain-based digital real estate NFT platform with integrated tokens for fractional ownership. That's not a story. That's spaghetti thrown at a whiteboard, and Lynch would walk away. The story filters complexity into human understanding. It aligns logic with reality. It gives you conviction when prices wobble, because when you know the story, you know whether a dip is a buying opportunity or a danger signal. He taught investors to revisit the story every quarter. Has the story improved, stayed the same, broken? That alone guides most decisions. A story that strengthens is a hold or a buy. A story that erodes needs reevaluation. A story that vanishes, sell. And this isn't just about stocks. This is life. Every career, every business, every movement runs on story. It's how humans interpret the world. We follow narratives, not data. We crave direction, not noise. So, the next time someone asks you about a stock, skip the jargon. Tell the story. If you can't, don't buy. If you can, and it feels true, powerful, and supported by action, you may be onto something great. And here's a twist. Sometimes the best stories don't come from Wall Street, but from a street corner, a shopping aisle, or a teen's phone screen. In the next chapter, we dig into Lynch's most unexpected superpower, the everyday investor's edge that no algorithm can match. Chapter 17, The Everyday Edge, Seeing What Wall Street Misses. Wall Street analysts sit in glass towers, reading earnings reports, building spreadsheets, and making calls. But Peter Lynch found his edge not in those towers, but in shopping malls, grocery stores, and kitchen tables. He believed the everyday person, you, has a frontline view of the economy that no analyst report can replicate. Because you see trends before they show up in data, you feel shifts in consumer behavior before they're graphed. This is what Lynch called investing in what you know. It wasn't a lazy shortcut. It was a lens, a way of translating everyday life into financial insight. Think about it. You see which stores have lines out the door. You notice which restaurants your friends keep revisiting. You hear which apps are blowing up in schools. You watch your family cancel certain subscriptions and double down on others. These are real-time signals, not theories, not forecasts. Reality. In the 1980s, Lynch watched his wife come home raving about legs pantyhose being sold in supermarkets. Not high fashion, just accessible, smart distribution. He connected the dots, trusted product, plus new distribution channel, plus repeat purchase. That was a clue. He didn't wait for an analyst to tell him it was a buy. He saw the story unfolding in real life and acted. Now, let's bring it to 2025. You're at Target. You notice an entire new aisle dedicated to a brand called Bright Nest. Eco-friendly, refillable cleaning products. You've never heard of them, but over the next month, you see their name pop up in podcasts, TikToks, and YouTube ads. Then you see a friend post their starter kit on Instagram. That's the everyday edge. You research. Turns out the company is publicly traded. Revenue is growing 60% year over year. They've just signed a nationwide deal with Walmart. That's not a coincidence. That's visibility becoming inevitability. Lynch believed that your eyes, ears, and habits are research tools. The problem is, we ignore them. We chase what's trendy instead of what's obvious. But in truth, some of the best stocks are hiding in plain sight, right under your nose. Literally. Have you ever thought, why doesn't someone invest in this thing everyone is suddenly obsessed with? That moment is your edge. Most investors wait until it's on CNBC. You have the chance to see it before it even makes a headline. So, here's a challenge. For 1 week, become a detective of your own life. What brands are you buying without thinking? What apps do you open most? What subscriptions feel essential? What's growing around you that no one is talking about yet? Because Peter Lynch's genius wasn't just in analysis, it was in awareness. He paid attention to the world, not just the market. But even awareness isn't enough unless you have the patience to let the story play out. In the next chapter, we dive into one of Lynch's most overlooked lessons: why doing nothing is often the most profitable move you can make. Chapter 18, The Power of Doing Nothing. In a world where every app begs for your attention, every alert screams buy or sell, and every influencer tells you what's next, you'd think that action is the secret to success. But Peter Lynch discovered the opposite. His greatest wins didn't come from constantly trading, predicting, or pivoting. They came from waiting, from doing nothing. He once said, the real key to making money in stocks is not getting scared out of them. That's not a sexy strategy. It won't go viral, but it's devastatingly effective, because most investors fail not from bad picks, but from impatience. They sell too early, they trade too often, they overthink. Lynch held some of his best picks for years, through recessions, through media panic, through boardroom reshuffles. And while others jumped from stock to stock, like frogs in a thunderstorm, he let compound interest quietly do its work. Let's imagine this in 2025. You invest in Neuronest, a company creating AI-powered learning tools for children. You believe in the mission. The product is gaining traction in schools. You buy in early. But 3 months later, the stock drops 18%. News hits about a competitor entering the space. Social media panics. You're tempted to sell. But here's the twist. Lynch wouldn't even flinch. He'd check the fundamentals. Are sales still growing? Are schools still signing up? Is the leadership still strong? If yes, he'd hold. Because in his world, a dip is a storm, not a shipwreck. By the end of the year, Neuronest announces a government contract. The stock doubles. And those who stayed? They didn't outsmart the market. They outweighted it. Doing nothing is hard. It requires faith, focus, restraint. But that's why it works. The world is addicted to motion. But investing is a game of stillness. The tortoise beats the hare, not because he's faster, but because he keeps going while the hare burns out. Here's the irony. Your edge might not be your research, your timing, or your strategy. It might be your inability to react, your power to not check your portfolio every hour, your decision to let the tree grow instead of digging it up every week to inspect the roots. Lynch's best advice wasn't buy this stock. It was know what you own and why you own it. Once that's clear, the next move is often no move at all. So, before your next trade, ask, am I doing this because the story changed or because my emotions did? Because if it's the latter, step back, breathe, and remember, in investing, silence is a skill. But what happens when a company has done everything right, and still, no one seems to notice? In the next chapter, we reveal the final piece of Lynch's playbook, how to spot a ten-bagger before the world wakes up. Chapter 19, how to spot a ten-bagger before the crowd. A ten-bagger, the mythical creature of investing, the stock that multiplies tenfold and turns a modest position into life-changing wealth. Peter Lynch didn't just chase these, he caught them, again and again. Not by luck, not by whispers, but by spotting them long before the world believed. The secret? He wasn't looking for flash, he was looking for clues. A ten-bagger always begins in disguise. It doesn't come with headlines or fanfare. It doesn't have a PR team. It just grows, quietly, relentlessly. Lynch learned that these companies often look ordinary at first glance, but once you understand the ingredients, the potential becomes blindingly obvious. So, what are the clues? Small size. Ten-baggers don't start as giants. They begin as overlooked gems, regional, niche, misunderstood. If a company is already a household name, its runway may be limited, but a small cap stock with strong fundamentals, that's a spark waiting for oxygen. Scalable business model. Lynch hunted for businesses that could replicate success. If one store does well, can they open 50? If one app takes off, can they dominate a vertical? Scalability is the secret fuel, accelerating earnings. He didn't just look for profitability, he looked for momentum. If a company grows earnings 30% this year and 45% next year, that's not linear growth, it's compounding acceleration. A strong story you can see and feel. Lynch didn't invest in theory, he invested in reality. He wanted to see customer lines, rave reviews, and brand loyalty. He wanted to hear the name pop up in ordinary conversation. Now, imagine in 2025, a company called Pulse Patch, a tiny wearable that tracks dehydration and recovery in athletes. At first, no one pays attention, but high school coaches swear by it. College teams start adopting. NFL sidelines feature it subtly. Then, a military contract appears. Earnings spike. Yet the market still calls it a novelty. But you, following Lynch's lens, see the story forming. Lynch's genius was not buying after the world noticed. It was buying while the world yawned, and he had the patience to let the story unfold. A ten-bagger doesn't double in a week. It grinds. It pulls back. It climbs again. It's a test of your thesis and your temperament. He once said, if you're not willing to own a stock for 10 years, don't think about owning it for 10 minutes. That's the ten-bagger mindset. Long-term vision, long-term conviction. But perhaps the most shocking truth is this. You only need one. One ten-bagger can forgive a dozen small mistakes. One insight, acted on with clarity and courage, can rewrite your financial future. Ask yourself, what do I use, love, and trust that no one is talking about yet? What trend is bubbling in silence? That is where the ten-bagger lives. And now, as we near the end, it's time to pull all the lessons together. In the final chapter, we'll return to the metaphor that guided us all along, the mall detective. Because in this strange market full of noise and smoke, being a calm, curious, everyday detective might just make you richer than any expert on Wall Street. Chapter 20, The Mall Detective Returns. Step into the mall. Not the digital one filled with charts and chaos, but the real one. The place where people live their lives, where parents shop for school supplies, teens try on new shoes, kids beg for snacks. This, Peter Lynch believed, is the real stock market. Not the tickers, not the terminals, but the trenches of daily behavior. And in this bustling marketplace, you are the detective. From the first moment you notice a packed store while others walk by, from the casual mention of a brand you've never heard that suddenly starts popping up everywhere, from watching where the lines form, which bags people carry, which products run out of stock, you are collecting clues. Not abstract theories, but lived insights. Lynch never believed in crystal balls. He believed in shoe leather research. If a store was expanding, he visited it. If a product was trending, he asked customers why. He didn't just trust numbers. He watched behavior. Because companies grow when they win hearts, not just earnings. Let's bring it to 2025. You walk into a tech mall and see a kiosk for hollow eyes, augmented reality glasses for kids with learning disabilities. You watch as parents gather, kids smile, the staff is swamped. A quick search reveals rave reviews, pilot programs in schools, and a surge in app downloads. Is it public? Yes. The company is small, ignored by analysts, but its story is unfolding right in front of you. That's your mall detective moment. The role of the mall detective isn't to predict, it's to notice. You notice before others believe. You ask, what's happening here, before CNBC ever runs a segment. You act based on clarity, not hype. You marry logic with life. And here's the final twist. The market isn't just made up of companies. It's made up of people, like you. Their habits, fears, aspirations. To understand the market is to understand humanity. The mall detective doesn't just spot brands. He spots shifts in belief. So as you walk through your everyday world, keep your detective's eyes open. Every checkout line is a clue. Every empty shelf is a whisper. Every trend your kids chase is a flare in the sky. You don't need to be a genius. You don't need to outcode, outtrade, or out-hustle Wall Street. You just need to be awake, curious, and courageous enough to trust what you see. Peter Lynch proved that the world's best investors aren't locked in skyscrapers. They're walking through food courts, asking the right questions, and acting before the crowd catches on. So, the next time you find yourself in a mall or a marketplace of any kind, remember, you're not just shopping, you're investigating. And somewhere in that ordinary moment, an extraordinary investment might be waiting. Because the mall detective never stops watching. And in a world flooded with noise, the quiet observer is king. You've made it through 20 chapters of insights, metaphors, and mind-shifting stories. But this wasn't just a lesson in investing. It was a transformation. Because from this moment on, you'll never walk through life the same way again. You are no longer just a viewer. You are a mall detective. You see clues others ignore. You listen with the ears of an insider. You observe with the eyes of a quiet genius. Where others see noise, you see signals. Where others scroll, you investigate. Where others panic, you pause and think. You've learned how boring names often hide brilliant returns. How kids and customers whisper secrets before the news catches on. How a dusty shelf, a packed line, or an empty cart can be louder than any earnings report. You've discovered the power of patience, the danger of diworseification, and the quiet magic of simply noticing. So, here's your next mission. Walk through the world like it's your research lab. Start your own idea journal, a simple list of brands, products, or companies you encounter in daily life that spark curiosity. And in the comments, drop the last product you or someone close to you couldn't stop using that no one is talking about yet. You might just help someone else catch their first Tenbagger. And if this journey stirred something inside you, if it made you think differently, feel smarter, or look at your surroundings with fresh eyes, then like, subscribe, and share this with your investing partner in crime. Because from now on, you don't just walk through malls, you walk through markets. And the next great investment? It might already be in your hands. The best investment you'll ever make is noticing what no one else does.